Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 9th, 2018 edition of Market Outlook. All right, so quite an unusual week. This is the first time in 17 years and only twice in recorded history that the market has been down 4 days in a row the first week in September. So that's highly unusual action. And with that said, the two other times that has occurred was in 1987, right? 1 month before the big market crash, and again in 2001. So not a lot of data points, but then again, there's not a lot of market crashes. So it is interesting to note. So with that, let's take a look at just what happened this week and where it's left us. So the first thing to note is S&P closed under the 10-day moving average. That was a key reference point that I had mentioned prior, that we were concerned about it breaking that level, which it did do. The NASDQ 100, we actually closed for it under the 10-day moving average for 3 consecutive days. Now, actually, the surprising thing is that the Dow here actually just closed under that 10-day moving average on Friday. Now, with that, IWM, same scenario. So, as you can see, in terms of real motion here, we're basically trading right at the lows over the last month. Any further decline of taking out the 50 and the momentum here would be a negative sign. And you can possibly see a correction at least down to 168 level, which is the 200-day moving average. So this is the key thing to watch, right? The NASDQ has been the strongest stock or the strongest index across all the indices. And as you can see, our TSI here is plus 4.68 relative to the S&P, which is 3.9. So very, very strong TSI. And the same thing can be said here for IWM. So net across the board, if you look at the real motion and the reading of real motion and the TSI, NASDAQ 100 is still our strongest index. We definitely want it to hold this 50-day moving average. That's pretty key. So there is your sort of overall setup. The other thing that's to note here is you sort of have an interesting trend line on real motion on the Dow, which held up better. But again, if the Dow takes out the low of the week, of the past week, that would be a real concern, because you can see certainly a test back down to 253 or even where it should find some support around 248. So that's your scenario on the daily chart. Okay, so in terms of the weekly charts here on the key indices, one of the most obvious points is on the IWM. And the reason for that is you can see you basically have been compressing here in terms of real motion. And with this little sell-off here over this last week, or a significant sell-off, we basically have been sitting also right at that 10-week moving average. But more importantly, you can see this compression zone on real motion on the weekly charts. If, in fact, we start trading under the lows over the last several weeks, or certainly since the summer, the low part of the summer, if it breaches that down in here, that would be a real shift in momentum. At the moment, we don't have that on the weekly charts. If that does occur, that would mean a major shift in trend. So we definitely want to keep intact or tracking that on the IWM. That's the clearest breakdown. The other one that would be really important to watch is the low back here on the NASDQ 100. So again, the lows at midsummer are really important to note as well in terms of real motion. So you got a couple things to watch, certainly on the daily charts, and if things deteriorate further, you can see a lot more pressure and looking for support, certainly at now the 50-week moving average, which is pretty close to the 200-day moving average as I showed on the daily charts. Okay, so now moving on to one of the key relationships in the market that's really a good risk-off indicator just by itself is looking at the ratio between the S&P and utilities, XLU. And so one of the things you can see, because of the sell-off this week, utilities are leading stocks, right? That red line here has breached the two moving averages of the ratio, putting this in a risk-off situation. Now, our other indicators are still in bullish mode, so overall, our risk-on indicators or risk-on, risk-off indicators are still favoring a positive outlook on the market. But this one, the S&P versus utilities, is definitely giving us a red flag. Okay, so the other key aspect is looking at sectors and just how many sectors were up versus down and which ones, excuse me, were leading. And last week it was definitely risk on. Things were looking really good. But now take a look. Consumer staples, conservative play, was up 1% for the week. In fact, consumer staples up over 1% for the week is the strongest performing sector in the market at the moment. And the other thing to note is utilities, a safety play, definitely performed well this week. The other thing to note, so complete changing of the guard, is semiconductors moved into a warning phase. So last week we were pretty convinced that the market looked good because of the way the sectors were acting, and it just reversed completely this week. I mean, that's just the reading. You can see our worst performing sector is semiconductors. And of course, XLK, technology. So those two spec sectors definitely looking weak, where the risk-off sectors looking strong. So net at the moment, the market seems to be under pressure. The other thing to note is in terms of market hotspots, when we look at this particular table, you can see that long volatility popped here. Although it's still in a bearish mode, it's very, very close to moving back up. If it continues to move up here, it's going to take out some key moving averages. Now, the other thing that occurred, which is also a good lesson and a good takeaway, is that Brazil, even though there was an attempted assassination of a presidential contender, moved up sharply this week, up 2.7%. Now, of course, year to date and over the last 6 months, this is one of the worst performing country funds around. But you did have a nice bounce despite that attempt on the life of an important presidential contender. The other thing to note, of course, is that solar, right, definitely got hit back and down into bearish mode. It was possible that solar might have been picking up there and turning around, especially looking at First Solar, one of the leading solar stocks, but that got hit. So interesting. Short emerging markets did extremely well, up 3.34%, but Brazil, right, countered that despite the presidential or the attempt on a possible future president of Brazil. So that bucked it. The other thing to note is that oil got hit really hard this week, and that was or is still, over the last 6 months, one of the best performing asset classes around, oil and just that whole energy complex. So interesting correction in the oil complex. So net overall, you're looking at a pretty mixed message, right? In terms of overall trend, still intact. We've got this short-term pressure. The sectors seem to be rotating between risk off and risk on each week, back and forth. So that's a bit confusing. Oil definitely taking a hit, and that is sort of counter to global growth. So key thing here, watch the price action that I noted on the key indices. That is the ultimate test. So we want to see the market, and certainly the NASDQ 100, hold that 50-day moving average. All right, so that's it for now. See you next week, and good luck with your trading.